The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
It's my favorite Friday of the month. Payroll hang on a second. There's no payroll. Dang. Anyway, it's still Squawk Box Europe, and you still have Karen Cho and Juliana Tattelbaum. And yes, despite the shutdown, Steve Sedgwick is still here. I know, it's a shame. These are your headlines. Equity markets in Europe and the US hit yet more record highs. Of course, nothing to see here. Putting the benchmarks on course for another solid week of gains as investors brush off fears over the aforementioned US government shutdown.
As it enters its third day, President Trump continues to threaten mass firings across federal agencies. Treasury Secretary Scott Bessent tells CNBC the Democrats should consider themselves responsible.
This is a choice that Schumer and Hakeem Jeffries have made. And if they want to shut the government down, then there are ramifications.
And Tesla shares reversed despite the EV maker posting record deliveries in the third quarter as investors worry about the fallout from expiring EV tax credits.
Well, we keep talking about this, the US government shutdown. The reality is markets keep on finding new theme to trade. And as a result, we continue to bounce across the trading week. Modest upside for the Dow, where it's been roughly in the vein of about 0.6%. But don't forget, it has been the third positive week in four. So it's the direction of travel that has been fascinating. The S&P 500, a little bit more than that. And you can see the NASDAQ 1.6%, again, the winner. The technology trade very much intact. Other big catalysts here, and we want to talk about some of the big drivers for the market. It's been the AI story. Again, we've seen that flushed out and investors now worried about some of the valuations, bubble-like territory. The big theme was pharmaceutical stocks that shrugged off some of the tariff trauma that they'd been facing, some of that certainty coming through to the likes of Pfizer with the deal with the White House. That was a big driver. But the other big one, front page of the FT this morning, is the multinationals and exporters that are outshining other domestic companies in the US, that there's now a divide because of the weak dollar, and that trade is bringing more revenue back home, bolstering the profitability of some of these big companies. I think that is fascinating that the markets keep on just skipping to one theme after the next, trying to trade the upside.
I think looking back, I mean, this is certainly a great summary of what we've seen this week. Looking back since the so-called Liberation Day, it really has been extraordinary how anything tech-related has absolutely gone wild. We've also seen a major appetite among investors for cyclical stocks, industrials, materials, financials. If you're worried about the economy, those are typically not the stocks that you want to buy. And the defensive sectors like healthcare, like consumer staples, have performed very, very poorly. And I saw some interesting stats this morning comparing the performance of value to growth over the last 6 months or so. And value has underperformed sharply versus growth when you look at historical performance. So if you are a long-term value investor out here, there are some major opportunities. But, well, I think you've got to time it well, and it may be a very difficult one to play out on depending on when you get in.
Come on, Karen. I love your dispersion conversation, but it's... can I be rude? It's by the by. This is you mentioned it. It was in there, but you hit the head because you were talking about farmers and multinationals and value stocks. You know the head here, and it's, as you say, this is the growth-driven Ferrari. It is the growth-driven Tempest, which has taken everything up. And just because growth valuations are stratospheric does not make value cheap. It makes value cheaper. It makes value a better relative trade, but it does not make it outright cheap. Now, look, I've been on the social media, we call it LinkedIn. Now, LinkedIn has proven to me a couple of times this week, it is not just about where people look for jobs. I've had great correspondence with Karim Musalem, who we had on yesterday, who I thought he was excellent. I've also got a correspondent called Justin. I won't give his surname as well. And he sent me a chart. Can't show the chart on the screen because it's proprietary. It belongs to one of the investment banks as well. But he says there is a scatter chart, and it's one of the big investment banks, one of the big ones in America. And he says it shows the historical performance of the S&P after the S&P 500 has hit 23 times forward, which is the aggregate of everything we just talked about, 23 times forward. The point here from Justin, again, I won't mention the investment banking, is that after the S&P 500 historically hits 23 times forward, the subsequent 5-year return, this is where it gets interesting for you lot out there, the subsequent 5-year return has been between 0 at best and negative 0.3 at worst. So this is the point. This is history. This is charts. This is how it has worked historically. Once you hit 23 times, the return after that is at best zip as well. If that's not another warning sign, I don't know what is.
It is something to be mindful of, and I think that blue sky scenario we keep on seeing expressed from investors is worrying some market participants. And just to flesh out what I was talking about, with the dollar being now the trade as we wrap up the trading week, we're hearing that Goldman Sachs, according to the FT, Goldman Sachs index of 50 blue chip US companies with the high share of foreign sales exposure has jumped 21%. Compare that to 5% on just a domestic gauge, those that are more domestically focused on sales and don't get the FX component. Stephen England, someone we've interviewed a lot on this channel from Standard Chartered, saying the weak dollar gives you a turbo boost. So terrific reporting from the FT this morning about that other layer that is in markets this morning that investors are chasing.
You know, just coming back to the conversation we had with Kareem yesterday, Kareem Muslim, who came on and flagged his concern around valuations in the AI space. He also pointed to the impact of the retail investor here. And I think that that's a big part of what's driven the extended rally in the U.S. Yeah, and I think the lesson that many investors on the institutional side have learned is not to fight the retail investor. And just this week, we've seen U.S. markets open lower. Futures have been negative, and then we just see buying into the close. So those who try to fight back against the retail frenzy, they haven't been winning.
Let's get another voice from Yoshi Kami in a minute. He's a great voice on this market. President Trump has threatened cuts to federal agencies and mass firings as the U.S. government shutdown enters its third day. In a post on his Truth Social account, Mr. Trump said he would target what he calls Democrat agencies. Wow, I didn't know they were Democrat. I thought they were federal agencies, sir. Anyway, Democrat agencies with the budget director Russell vote to determine whether cuts will be temporary or permanent. The administration has already halted more than $25 billion in funding for infrastructure and green energy projects since the shutdown began on Wednesday. Well, no payroll. I love payroll. I don't know why. I think it's because when I used to stand in the pit back in the day, it was so exciting, one Friday a month. But anyway, no non-farm payroll. Boo-hoo. We're tracking alternative reports on the US labour market. Data from the Chicago Fed showed the unemployment rate ticked slightly higher to 4.34% in September, with the hiring rate for the unemployed dipping slightly. Separately, a report from outplacement firm Challenger Gray and Christmas. We're not allowed to mention Christmas yet, it's not November. Anyway, Challenger Gray and Christmas showed new hirings down 58% so far this year to their lowest level since 2009. The data showed layoff announcements declining 37% in September, but so far for the year, job cuts are at their highest level since 2020 and up 24% on the year. Speaking to CNBC, the Treasury Secretary Scott Bessent said Democrats are responsible. All the Democrats' fault, sir. Yes, Democrats are responsible for any consequences for the shutdown.
The president, Vice President Vance, Speaker Johnson, Leader Thune, they're not negotiating with Chuck Schumer and Hakeem Jeffries. They're negotiating with Representative Ocasio-Cortez because she's nipping at his heels. This is a choice that Schumer and Hakeem Jeffries have made, and if they want to shut the government down, then there are ramifications.
Let's get to U.S. markets. You can see here all three of the majors finished the session yesterday higher, but it wasn't all roses yesterday. We started out on a downbeat note, and markets struggled throughout much of the day, many chucking it down or chucking it up to jitters around the government shutdown. But ultimately, we saw tech rally into the close. The tech-heavy Nasdaq closing about 0.4% higher, and the S&P 500 actually crept to a new record high. In terms of sector performance, we saw the energy sector underperform, down about 1%. Overall, materials was actually the best performer of the day, up about 1% in the end. In terms of Asian trade overnight, very strong performance over in Japan. The Nikkei 225 up 1.7%, seems to be on the back of a surprisingly dovish speech by the central bank governor that helped boost sentiment there. You're also seeing some gains for the Australian market. Meantime, over in Hong Kong, the Hang Seng underperforming, down by just over 1%. Here in Europe, let's take a look at where futures stand. It has been quite a strong run for European markets, 5 positive sessions in a row. Stock 600 gaining about 0.5%. So one of the interesting trends this week has been the outperformance of Europe and Asia versus the United States. And now it looks like those gains are going to continue into the final day of trade of the week. Now, in terms of U.S. futures, here's where things stand this morning. As Steve obviously said, not as big a day as we were expecting, given that we're not going to get that key non-farm payrolls report, and at this point we are looking at muted gains stateside. Michael Yoshikami joins us now, CEO and founder of Destination Wealth Management. Michael, it's great to speak with you once again. Always great to hear your thoughts. What's your take here on the rally that we've seen in markets? It feels like when you look at the U.S., and maybe we can start there, sentiment is not necessarily gangbusters. Every morning this week, basically, we've started out on the back foot, but ultimately investors just keep coming in and buying those U.S. stocks. Do you think that rally is going to continue?
Yeah, I think sentiment's actually better than most people think. Even though the markets start off kind of soft, I think that what you're really seeing is this huge rush, and it really is a rush to get in on a couple trades. Obviously, the AI trade is everyone's trying to crowd into. The other rush is if interest rates, in fact, are going down, participants are betting basically that that's going to stimulate growth. If it stimulates growth, that's going to help corporate earnings. And I think that's why you're starting to see some of these other sectors that you mentioned bouncing a bit, despite the concerns about future returns, as Steve mentioned, relative to what the market's done in the past when valuations were where they're at now.
And do you think that low rates will stimulate growth? I mean, obviously it depends on what the cause of the weakness is, what the cause of the labor market weakness is. And you can argue that some of the cracks that you've seen in the labor market are down to the AI revolution. And I'm not sure how much low rates are going to do to address that issue.
Yeah, well, I think you're right. It's all about the labor market. And I was talking to another strategist just the other day. We were commenting on when the jobs reports come in softer than people expect. I think there's an overemphasis on high expectations for job numbers. I think job numbers can come in lower and still have a growth-oriented economy. So I don't think this is really going to be killed by softer employment reports. And I do think, in fact, even though it might lead to not great standard of living in the United States in terms of stagnation and inflation, I do think you're going to see the markets buoyed by stronger corporate earnings. And I think lower rates are going to do that.
Michael, it's Karen jumping in. Good morning to you. The trade this morning that we're also discussing, the FT is highlighting this, the amount of trading around the FX story, the weak US dollar that is bringing in more sales overseas. It suggests that traders are banking on the short and medium term picture of a still weaker dollar from here. What do you think of that trade?
I agree with that trade completely. In fact, that's the whole point of global assets in a portfolio strategy, that you're participating in some growth in the economy, but you're basically getting the tailwind from FX. So I think that investors, as you mentioned in the Goldman report that came out, investors are looking at reports that show that if you have the right currency tailwinds, you don't even have to have great business, so to speak. Just the currency can help you. Now, it can work the other way as well, and that's something investors need to be wary of when that turns. But for now, that certainly is an opportunity I think is worth chasing.
Well, I want to pick up on the word opportunity because it feels like a very tough market to navigate if you're looking for upside and you're still sitting on some dry powder. What do you recommend? What is the strategy from here?
Boy, it's tough. When you say dry powder, you're talking about cash. Do you buy markets at all-time highs? That's really the classic issue. The answer, in my view, is you can do that, but you got to do it kind of chopping in, kind of a DCA sort of strategy. Look for down days. But I think this kind of waiting around for 20 or 30 or 40% drops and then you get in, I think investors out there have been doing that and the market's gone up 10 or 20 or 30%. So I think it's a better idea to pick your stocks and then drip into these stocks incrementally. Don't buy your whole position. Buy 5%, 20%, 30% of your position. I think that's how you can creep into a market like this and not get left behind.
Michael, you've already come up with some brilliant answers to some great questions. I haven't got many smart questions left to say, but look, I want to go all VC on you. We know that most of these tech companies, they won't make it. It's the truth. Even if AI is amazing, even if the technology makes vast amounts of money for the ones that do make it, 8 out of 10 of these ladies and gentlemen making these companies, it's going to be pie in the sky. Do you think there's enough differentiation going on at the moment?
Well, I think if you have 8 out of 10 companies going out of business, and you're absolutely right, Steve, that's the whole VC business is all based on that. What are the 2 out of 10 going to do? They're going to just soak up all of the technology hunger that people have for AI. So the bottom line is, even though you have 8 that may fail, the 2 are going to grow so much that I still think it's a trade that you make. You just got to be careful. It's a good point you make for investors, because people are always asking me, what's the next whatever, XYZ stock? Well, the next whatever could be one of those 8 out of 10. So you got to be very, very careful. It's a matter of whether you're speculating or you're buying growth. But I think there is still enough energy behind this trade, even if those 8 go out of business, because the 2 are going to be so monstrous. I think it's still going to provide opportunity.
Okay, and I'll run with the theme, and thank you for picking up with it. Let's say OpenAI, which isn't even listed yet, is one of those companies. The way that that company's valuation has gone up exponentially as a private sector company over the last 18 months, don't you think, though, that is symptomatic of even the survivors, even the winners, are going to need a really big pause at some stage?
Yeah, maybe. But I mean, what's the valuation? OpenAI's valuation from this last funding was $500 billion. What's Tesla's valuation right now? I mean, so the question really is, how big is AI going to be? And it is going to be gigantic. It is going to be huge. That's why these data centers are getting open. And that's why people are falling over themselves to contribute to OpenAI when it was at 300 or 400 billion. So I do think there's going to be a pause. This is not straight up NASDAQ 1999 web van kind of stuff or pets.com. I think these are companies that have real earnings, and already AI is being implemented into companies in terms of how they operate. And I think OpenAI is just another example of one of these companies that's going to be well positioned going forward.
But there was a slight of you could be the next Copperfield. You're such a great magician. You compared OpenAI to Tesla just then as well. And Tesla is an extraordinary comparison, because you know way better than I will ever do. Tesla is not being valued on the sales of the stuff it sells now. It is being valued on what it can do with the CEO, what AI it can do, what robotics it can do, and what it can do on the energy front as well. It is still an enormous punt on future technology, not on real revenues today.
That's true. That's absolutely true. And Tesla's an example of a company that's betting on future revenue and whatever tricks Elon Musk has up his sleeve regarding the next way he can grow earnings. So, it's all about anticipation, right? I mean, you've been around this market long enough, Steve, to know that it's all about what is the anticipation of what the growth rate is going to look like. And when you have company after company after company talking about how AI is revolutionizing their business, I'm not saying there's not going to be a pause. There's going to be a pause, and probably there will be some significant correction down. But the overall trend, I just don't see that it's going to be stopped going forward.
We never, ever finish a conversation with you not wanting more, Michael Yoshikami. I loved it. Have a brilliant day. Have a brilliant weekend. Thank you for joining Karen, JT, and myself. Michael Yoshikami, CEO and founder of Destination Wealth Management. What is coming up on the show?
Well, we're going to be talking Tesla. Yeah, we got shares dipping in yesterday's trade, despite the automaker posting record sales in the third quarter. We'll break down those numbers. Plus, there's more trouble for France's new prime minister with the budget deadline rapidly approaching. And we'll wrap up a busy week in pharma, including Genmab's latest acquisition, when we're joined by the biotech firm's CEO at 8:15 London time.
French electrical and digital infrastructure firm Legrand will acquire US company Avtron Power Solutions in a deal worth $1.13 billion on enterprise value basis. Legrand said the acquisition of Avtron, which generates almost half of its revenue from data centers, will strengthen its presence in energy transition-related solutions. Benoit Coquart joins us now, the CEO of Legrand. Thank you so much for joining us, Benoit. If I could just background for the audience to an extent on what Legrand does. You do work with a lot of data centers on power, cooling solutions and scaling. So how does Avtron fit into that mix?
Hello, thank you for taking the time to discuss about Legrand. Yes, indeed, we have become over the year key player in data centers, both in white space and in gray space. And actually, we've been adding applications to a portfolio of solutions. And Aftron is a great play. Actually, Aftron sells what we call load banks, which are basically equipment that simulates an electrical load to test whether the electrical installation and the power supply is reliable, which is, of course, extremely important in a data center because you don't want to power the data center and face any issues. So you'd better test all the electrical equipments before doing that. So yes, it's one more product lines we are adding to a portfolio of solutions in order to better serve our data center customers.
So the power bank important when it comes to the data centers, but we've been hearing this week that there is a problem with the electricity grid, particularly in Europe, less so in the United States. But that said, it's still going to be an issue. Can you take down the power consumption at the data center level?
Not specifically load banks, but we have within our solutions, about half of our sales made in data centers are made with products that help saving energy. And indeed, it is a strategic challenge for many data center operators to cut down what we call the power usage effectiveness of the data center. And Legrand Set of Solutions help doing that.
Really good to see. By the way, I came through Limoges this summer. Fantastic place where you're headquartered. No, it won't have got lost on anyone that this is a Cleveland, Ohio company you are buying. And it carries on the trend that we saw under the last administration where European companies are buying American companies for their growth as well. Is that still the trend under this administration? And of course, as the pressure's been tweaked because of the tariff situation, that actually the best growth you can find is in America?
Well, we are looking at acquisition opportunities not only in the US, but elsewhere. Now, I don't see Legrand as a pure French company, even though I'm French, you can hear it from my accent. But typically, we today do 40% of our sales in the US and only 12% in France. So as many French companies, we are now truly international. And I think that from a US customer standpoint, we are as American as French.
To come back to my same question. I can tell you're French and you've got a beautiful accent, of course. But the fact of the matter is you are buying American and growing American assets or international assets. Yep. Is the best growth opportunities outside of Europe still? Yeah.
Actually, the best growth opportunities in today's world, at least for a company like Legrand, comes from everything which relates to data center and the growth of AI. That's what the gentleman right before me was saying. So it is a fact that today, most of the AI-related trends are coming from the US, the technologies are coming from the US, and the key worldwide decision makers are US companies. So if we want to be a relevant player in this space, you have to grow in the US and you have to tie up and partner with US companies and US customers. And that's what we've been doing with acquisition.
Benoit, clearly data centers are now a significant part of the business, a significant contributor to Legrand's revenue. How do you think about, or what are your growth expectations for this segment in the coming years?
Yeah. It's going to be about 25% of our sales in 2025. So it's a significant number. And we think that in 2025, the data center business at Legrand will grow organically between plus 20 and plus 25%, as opposed to more or less a flat business for building activity. So indeed, it's growing fast, and we see this business growing in double digit throughout 2030. So it will continue to be a super positive trend that will definitely help Legrand to grow.
And when it comes to future acquisitions, you sort of hinted that you are continuing to look at growth opportunities outside of the business, outside of the organic opportunities within Legrand. What are the criteria that you think about when you think about future acquisitions?
We made it clear publicly that we're going to spend about 5 billion euros throughout 2030 to buy companies. And we are basically looking at leaders. So companies that are either number one or number two in their trade, which have a strong market position and which are good complement to the Legrand current product offering. And that's exactly what Aftron is about. Now, of course, those companies could be in the US, but we would also be delighted to make good acquisitions in Europe or elsewhere. So we're not solely looking at the US market.
Benoit, let me just squeeze in a quick question around the comparisons of the US to Europe on the AI data center build out. How much more advanced is the US versus Europe?
Well, 50% of the data center market is definitely in the US as opposed to 50% for the rest of the world. So the US is by far the largest market. And indeed, the US are trendsetters. Now, it's all about what you are looking at. When it comes to the AI model, I think clearly the US companies have a clear advantage compared to the rest of the world. When it comes to infrastructure-related products, so the products which are used to power a data center, which are used to make those data centers more energy efficient, I think a number of European companies, including Legrand, are well in the race. So it's all depends on which piece of AI you're looking at.
Benoit, thank you so much for joining us this morning, fleshing out the acquisition and the strategy moving forward. Benoit Coquart, CEO of Legrand. Let's take a look at European futures as we head to break about a half an hour away from the opening of the final day of trade of the week. And we're looking at more gains across the board. So a continuation of the rally we've seen over the course of the last 5 days.